All right, hello everyone. Jim Penna back here. I see the room is still filling up, so I went through our quick technical test, so I think everybody can hear me and see my screen okay. For anyone who's still coming into the room, and if you're new to GoToWebinar, you've got your control panel here. You have the chat box. We urge you to interact with us. If you've got questions, comments, anything, go ahead and type them into the chat box here. I'm joined by my friend and colleague, Mr. John Marabu. He'll be helping out answering questions in the chat box, so go ahead and ask those. Before we're done here today, we'll make sure we go through, get as certainly all of the questions that you guys have answered before we're done. So I'm really excited. I think this will be a great webinar. I'm excited to share the important concepts of building and managing your retirement portfolio with you. So hopefully you're here and excited as well. Before we get started, let me just ask you, be sure, and I'm not going to tell you to turn your cell phone off. I know you're going to leave it on vibrate. Everybody's got their cell phone in their hand, but close the door, have a notebook, a pad out, a beverage, perhaps an adult beverage if you need one, but try to focus on what we're doing here. It helps, and I promise that I'll give you everything I can during the next hour or so to introduce to you the VectorVest techniques of building, managing your retirement portfolio. Okay, so if that's good with everyone here, go ahead and type in the chat box. Let's go, and we'll get started. There we go. All right. Let's do it. I see a couple of familiar names that are in the chat box, but there are some that I do not recognize. So let me introduce myself quickly. My name's Jim Penna. I'm the manager of retirement services here at VectorVest. I've been with VectorVest for about 14 years now, and it's been a great run down here in just north of Charlotte, North Carolina. We are. Before working with VectorVest, I lived in the New York, Connecticut area. I was worked on a trading desk for a market making firm. Uh, what's getting a long time ago now, it seems. But I worked up in that area till I decided I didn't like the snow anymore. I took my wife and kids down this way. And I worked on some smaller trading desks for brokerage firms before getting onto the market making desk. So I took my Series 7 back in, what was it, 1992, and that's kind of my history in the securities industry. I like to say real quick though, in two lifetimes, prior lifetimes, I in Connecticut I actually was a police officer for almost 10 years. And so I like to let you know that if at any point it sounds like I'm telling you what to do here, that that's where that comes from. Okay. Now, I am just one of many on our education team here. Miss Linda Royer, Mr. Don Payton are the uh, are the upper management here, and they make sure we stay in line, and we're right behind them. So these are my colleagues. I'm one of many here in the education department, and we're happy to be able to bring these webcasts to you. Now, let's get started. I found this slide just picture this just the other day. So it was kind of a last minute insert into the presentation here. But I love it. I love to be able to find pictures that kind of convey sometimes what I can't always convey in words as well as I'd like. So I found this and it just kind of hit me. So I threw it in here at the beginning. Success, what people think it looks like, right? That it's easy. People who are successful got there, just on that straight and narrow road. And here's what it really looks like. And so I thought that was kind of a good way to start our session. My job, my goal is to unwind that tangled web there best I can to get you to be successful in when it comes to the foundations of building and managing your portfolio. So I don't know, 3, 4 years ago, I guess I had a maybe actually probably more than that, 5 or 6 years ago, I had a conversation with our founder and mentor here, Dr. Bart Delito, created VectorVest 30 years ago now. Excuse me. And so I had this conversation with him, and I was letting him know that my interaction with our subscribers, our retirement minded subscribers, whether it was at our live seminars we used to have, emails, phone calls, whatever it was, I, I was chatting with him and I told him the conversation always led back to this question in some form or fashion. This question would come up, and it was, how do I keep from running out of money in retirement? And so Dr. D said to me, in only the way Dr. D can, he looked at me and said, James, just tell him to keep making more money. And he was kind of kidding, but very serious in his incentive and his motive, just to keep making more money. And that idea that became kind of the backbone of what we call the ultimate retirement solution. Right there's a lot of ways to introduce all of this, but how do I plan and get through retirement? So we're going to talk about doing that with your portfolio, the equity that you allocate to the equity markets, your capital that you allocate to the equity markets, to help build that foundation. So it's our mission here at VectorVest to do our best to show you that you can retire with peace of mind, knowing that you can steadily grow your portfolio, that you can generate a safe, steady income, for me, most importantly, is that you can preserve or protect your capital. Right? Preserving and protecting your net worth, to me, of the three core strategies we're going to talk about, is the most important. And here's where I always cite a great quote from the well-known, famous hedge fund manager Ray Dalio, and I paraphrase a quote I read from him a long time ago. It stuck with me for a long time. And he said, "Listen, you can't make money in the market without taking some risk, and you certainly can't keep your money if you're not defensive and you don't know how to defend your portfolio." So that has stuck with me for a long time. And really, it is right. Even if you're making money, what good is it if you can't keep it and you don't know what to do when the market turns against you? So it's a big part of what we talk about. Now, we define a secure retirement here at VectorVest as one in which you have enough income to live the life you desire. Right? We could use the cliches of, buying a wine vineyard or sailing around the world on a sailboat and all that stuff, but it's whatever you want to do, right? I know I just want to play golf, sit on the front porch, drink some cold beers, and read a book. Right? That's about all I'm looking for. But everybody has their different life that they desire. Mine is that. It's pretty basic. But the key is where work is optional and retirement is affordable. Okay, that's the key. So we build that around this peace of mind that we talk about. And here's the foundation that we're going to talk about it as we get going. We're talking about what we call the three P's: profit, provide, and preserve. Profit will be the first core strategy we talk about. Basically, it's capital appreciation. How to take the growth portfolio portion of your retirement nest egg and get you off that roller coaster that, listen, nothing goes straight up. We understand that. But there's no need to have that equity curve on your portfolio that looks like this. Instead, we rather see a much more steady climb. Again, understanding that nothing goes straight up. On the provide side, what we're talking about here is specifically generating income, whether it be through good quality dividend growth stocks or selling covered calls against the stocks that you own, or doing what's called a buy right, where you buy a stock and sell a call simultaneously with the objective of generating income. The goal here is that you don't have just a couple of random dividend stocks where you see some income trickle in. We want that steady flow so that you can have that. Again, remember, the goal here is peace of mind in retirement. So steady flow of income is certainly a great way to get there. And then, as I said, preserve your capital. Go from being unprepared to knowing exactly what to do, when to recognize that it's time to be strategically defensive in your portfolio. Okay, so that's what we're looking to do with the three core strategies. So if I break it down just one other way, we talk again capital appreciation, income, and capital preservation. Okay, these are the three core strategies that we look for. Let's start with capital appreciation. We say that capital appreciation comes from owning companies with consistent and predictable financial performance. Okay, pretty straightforward. And every time I read this line, I just have to say, what two better adjectives to define or describe the type of stocks that reside in your portfolio than consistent and predictable? That's what we're looking for. So that's where it begins: consistent and predictable financial performance, putting good quality stocks in your portfolio. Now, I 4 lifetimes ago, I played baseball in college. I'm going to use a lot of baseball analogies and sports analogies, but here's my first sports analogy. Good portfolio management starts with buying the right stocks. Dr. Delito wrote and said many times over the years. Okay, it starts with buying the right stocks. Again, I grew up in Connecticut, not far from Shea Stadium. I was a big Mets fan, and the reason I put this picture up here is because I want you to think of building your portfolio or this roster of stocks at, as if you were the coach, and insert any team or sport that you choose to. And we come in here and we're looking at this and we're saying, okay, how do I put the best team on the field, right? Well, if I'm the coach, who's Gil Hodges here, right? I'm going to have Tom Seaver as one of my stock picks. Jerry Kuzman, we got Cleon Jones and Tommy Agee, and you got all these great players on the field. And so I use this as an example of putting the right stocks into your portfolio. Right. So if you had a second baseman on your team and you were the manager and he made 3 errors a game and struck out 4 times a game, what would you do with that player? Right? You you get him off the field, right? The same way if you don't have a stock that's performing or living up to what your objectives and goals are, then you got to get it off the field. How do we do that? Well, it all begins with safety first. Okay, it all begins with safety first. So in other words, for our retirement account, especially our growth portfolio, we look at stocks, uh, a company's safety more than anything else. And so, to continue the analogy, while it's fun to hit the home run, we've seen a lot in the headlines, the GameStop and the AMC and all the pot stocks and stuff. While it's fun to hit the home run, what happens to most home run hitters when they don't hit a home run? Who can tell me in the chat box? Make sure you guys are with me. If a home run hitter doesn't hit a home run, man, he strikes out, right? Yeah, William got it. And that's not what we want. That's not what we're looking to do. We're looking to build and grow that portfolio based on safety first. So in the VectorVest program, we have a proprietary indicator that's called relative safety. It's defined as an indicator of risk. Okay. And again, consistency and predictability of financial performance are the primary factors that go into assessing what we call relative safety. Also, for those who might be new to the VectorVest program, we take our fundamental and we have technical indicators that Dr. DeLito created. They are called relative value, relative safety, relative timing, and they roll into one indicator called the VST, or the value safety timing vector. Okay. And we put those numbers on a 0 to 2 scale so that you can compare, uh, one stock to another. Without these indicators might be a little more difficult, right? They say instead of comparing oranges to apples, it gives you the ability to compare stocks. So we rank them on that 0 to 2 scale. So the information that comes into the VectorVest program, the data that comes in, if you tried to go out and find it on your own, yeah, you can find some of it, but to get to the level of the VectorVest information, it can be a very daunting challenge to get that kind of information. You get buried by a lot of data. It gets frustrating. We don't want that to happen. So I want to take just 30 seconds to explain. I could do an entire session on just the information that goes into the relative safety indicator. But there are specific things that are in the valuation and earnings. I'll just talk about a couple of them. Earnings consistency is important. Of course, does the company make money quarter over quarter, year over year? We know that earnings is what drives individual stocks, and it's what drives the overall market. Company size, price behavior are, again, factored into that relative safety number on that 0 to 2 scale. How long has the business been around? Dr. D always talked about, better the devil you know than you don't know. It's not that a newer company can't be a good quality company, but on the more prudent slash conservative side, that's an important factor. Dividend history is an important one. Not every high relative safety stock pays a dividend. In fact, a lot of them don't, and that's okay. Right? That's not a factor in being considered high with high safety. But here's the thing: if the company does pay a dividend, they better darn well continue to pay it, and in fact grow that dividend, and certainly never either suspend it or cut it back, because as Dr. D wrote in his book, he wrote that there's not a greater black eye for a company than to have to suspend or cut their dividends, and so that's a big part of it. And then finally, debt to equity ratio. balance sheet stuff. Is the company well prepared for any headwinds or issues it might run into, whether it's specific to the company or the overall economy, whatever it might be? Is that company prepared to make it through that? And that is all considered in there. So I like to take a minute or two to talk about this because I don't want to just say, hey, relative safety is high here and not give you an idea of, there's a lot that goes into that. Okay, so that's why I take the time to go through that checklist. Here's an example of a stock. This happens to be West Pharmaceuticals, WST. I took the screenshot just about a week ago, well, exactly a week ago. It has on that 0 to 2 scale. On this date, it had a relative safety number of 1.48. That's excellent on the VectorVest scale. Okay, I have this set to a 5-year look at the history of the stock. In VectorVest, I can go back 25 years, as I'll show you in a bit, on a different stock. But what we're seeing here, again, is the earnings per share down on the subgraph. VectorVest takes historical and forecasted earnings, and we graph it here to look at the strength and power of the earnings growth. And then, of course, we look at the graph pattern of that underlying stock. And as I like to say, it's not a coincidence that as the earnings per share move in this northeasterly direction, so too over time does the price of the stock. And I said earlier, no stock goes straight up all the time. It's to a point now where I can look at a stock's pullbacks and know what calendar date it was, right? So it gets easier to do that. And this was the pandemic sell-off. This was October of 2018. But this is a good quality stock. It's one I own in one of my retirement accounts. Now I could scroll through 20 different stocks and show you the similar graph pattern to make my point. But for the sake of time, I just this is what good quality high RS stocks usually look like. Okay, so now what I did do was add the dividend payout to the subgraph. Now, as I said, all high RS stocks don't necessarily pay a dividend, but if they do, I just wanted to show you what it looks like when they continue. This again, still only 5 years. I'm going to go 25 in a bit, but what I like to call that golden staircase. The dividends continue to grow, and you're confident in the growth of those dividends because the company's continuing to earn money. That's what we look for in a good quality high RS stock. These are the type of stocks we want in your retirement portfolio. So you can go into one particular search, my favorite search in the VectorVest program. If you click on the Unisearch tab along the main toolbar, it brings you into our search directory where we categorize our searches: prudent, conservative, aggressive, and we have a whole bunch of names, a lot of searches in here. But ruler stocks is my favorite. It's based on relative safety is really at the core. Right, just to make the list and the scan and the search of the 8,500 stocks that we track, the relative safety has to be at least 1.4. And the earnings growth rate has to be at least 14% per year. As you can see, GRT stands for earnings growth rate in percent per year. And then we top it off by combining the two to bring the best combination to the top of the list. So as of about last Friday's close, Tesla was at the top of this particular list. Boston Beer, Sam Adams there, HCO. So AMD, I'll talk about in a little while. Some great stocks on this list. And then the final point I want to make is that when you see relative safety at these levels, not always, but generally what happens is all of the other numbers that we care about is fall into place. So RV, I'm not going to go too much into that, but it's relative value. It's the price appreciation potential of the underlying stock. Anything above 1, of course, favorable. You see strong numbers on the growth side here. Relative timing is an indicator of the current trend. Now, we're obviously up until last week, and we still are, I guess, even though we had a down day today, the market is trending higher, of course. So relative timing is very strong on a 0 to 2 scale. And then we have our other indicators there. Jay's asking, is that dividend by percent? The dividend that I showed here is not the percent. This is the growth of the actual dividend payout, the annual payout. Good question, but I'm going to talk more about dividends in a minute. So that's ruler stocks, one of my favorite searches, just to show you There are other great searches. There's many of them. Long-term winners is a great one in our program. Basically, all it does is sort the database by relative safety with some very basic indicators I won't spend time on here. No, no pink sheet stocks. Certain volume has to trade above a buck. But again, you'll see, very well-known stocks come to the top of this list. There's West Pharmaceuticals on this list just last week as well. So long-term winners, and then there's one called worry-free winners. A little different take. It's got a technical indicator here. A 50-day has to be above the 150, has to be a buy-rated stock. So again, you'll see the high numbers there. So just some examples of some really good stock, and then, again, there's more, but relative safety is really at the core of what we talk about when we're putting together our growth portfolio. So when you focus on a portfolio like that with the high relative safety stocks, and you use now what this means, this is a ruler stock portfolio that is just about 4 years old. It began in January of 2017. This PLP customized, don't worry too much about that. It's our Profit Locker Pro proprietary risk management software. So it just builds the stop criteria for us. I customized it a little bit. It's just look at it. Understand it's just a prudent slash conservative risk management technique. We give the stocks room to breathe, so we're not they do trade, but they're not actively trading and getting stopped out and doing 1,000 trades a year. Think of it, you could use, if the recommendation becomes a sell or a 15% trailing stop, something like that. Just giving a good quality stock some room to breathe. And this is the portfolio that this was just up to a few days ago, maybe a week ago. We were up 140% in the portfolio. Again, this is the date it began. Now you'll see the drawdowns here, and I'm going to talk a lot about that before we're done here today. But you have that steady rise, right? There is a little bit of a roller coaster, but we all know what happened in February of last year. But we have ways to mitigate that as well. So let's take a look at this portfolio. It's 140% return in 4 years, 4 years and a month and a half, I guess. That's a 34% annualized rate of return. 34% annualized rate of return. Okay. Now, your first question usually is, or most folks, and that's why I put this up here, because I usually get the question, how did that perform against the overall market? So if you look at the S&P 500, was up 74%. We virtually doubled the annualized rate of return as well as the overall gain. Right? So, it certainly outperformed the overall market with good quality stocks. And again, some pay dividends, some don't, but it's growth here that we're looking for. Okay. And this particular result does not include dividends. Okay. Again, not all ruler stocks pay a dividend, but there would be dividends and dividend reinvestments if you had them, which I'm going to segue into that right now, a dividend portfolio. So it's just a great way to build a growth portfolio focusing on relative safety. So I'll ask you, I talked about the roller coaster earlier. I want to be able to interact with you guys, make sure you're with me. I know the answers to the questions you're going to ask, but it gives me a second to pause and take a quick drink of water. So I'm going to ask you, would you rather build a portfolio, haphazardly with no safety concerns and live through that roller coaster ride, or would you rather have safety? So either type no for no safety, or safety if that's a way that you'd rather build your retirement nest egg. I'm just going to take a quick sip of water. Okay, thanks. Great. Yeah, no roller coaster, Robert says. Say everybody's typing in safety. Like I said, I know the answer. I just want you guys to interact with me. So that's fantastic. Yeah, of course we'd rather have the safety. So that's the shift we want to kind of make. Okay. So that's core strategy number one, focuses on relative safety. That's capital appreciation. What I want to turn to now is focusing on income. And income is very important. Now, we're shifting gears here, okay? We're going from a different objective, from growth and capital appreciation to income, right? The way you determine, the way you decide to allocate your retirement nest egg is going to be up to you, because we're going to talk about under the income umbrella, not just dividends, but selling covered calls. So you'll decide how you're going to allocate to all three strategies, to any one or two of them. It's going to be up to you. But let's talk about income. And steady income flow comes from both dividends and covered calls. Now, I'm usually I do it a little earlier, but I'm going to do this right now. I'm going to take 30 seconds out and talk real quick about covered calls. Um, Thanks, Dean. Yeah, I'd be like Joe Buck in the booth. If you guys read that story. Okay, so covered calls. I'm gonna talk about, before we're done here today, covered calls and protective puts. Now, I don't know, and you don't have to type it in, but I'm gonna guess there are some people in the room here who have not traded options and don't feel like, option experts, and I can't do that, or because it's an option trade. Please, please don't do that. I'm begging you not to. Selling covered calls and buying protective puts is an essential part of, remember I talked about building and managing your portfolio. Building it is one thing, managing it is another. So selling covered calls and buying protective puts does not require a PhD in option trading. They're two of the most popular, most basic trades. And if you're here to build that foundation, to build and manage your portfolio, I think they're essential. So we're going to talk about them here, and please don't. If you don't trade options, don't worry. I'm going to show you how easy and helpful it can be. All right. So first, let's talk about dividends. Right. We're part one of providing income is going to be dividends. We want to get paid. Right? We want that steady flow in our portfolio, and it's amazing how collecting dividends over time and how they compound is an amazing thing. And there's I used to have 4 or 5 slides just on the statistics of the power of compounding. But I think you guys understand, if you just keep reinvesting your money over time, it's going to grow, not just from the dividends, but the reinvesting in the growth as well. If you go into Google and you start to Google good dividend stocks, don't, what it's going to do is sort them all the time by the highest yield, right? Highest yield dividend stocks. I don't want you going in and chasing the high yield, looking for just the high yield dividend stocks, because it tells me nothing about the quality of that underlying asset, whether it's an ETF or a stock or whatever it might be. Okay, where there's a lot of different sites you can go to, but you'll see they always sort them by the highest yield, and that's a big mistake people make, because if the company can't afford to continue to pay the dividend, um, then you don't want to be involved in that. So in the VectorVest program, what we do is use several pieces of information. First, I'm here in the Viewers tab that brings us to our watch list viewer. And we have, under dividend payers, among other categories, but in the folder dividend payers, we have what we call the DRIP watch list. And DRIP stands for Dividend Reinvestment Plan. So I always go right to the 25 plus. We have 10 to 24 years and 5 to 9 years. We have master limited partnerships that pay, big dividends, closed-end funds. And we even have monthly dividend payers. But I usually head right to the 25 plus. These companies on the DRIP 25 plus are companies that have not only paid but have grown their dividend year over year for at least 25 years. Now, you may have heard of dividend aristocrats. Those are the same thing, companies that have grown their dividend for 25 plus years, but are also specifically members of the S&P 500. So not all of these stocks, many of them are or have been in the past, come in and out of the S&P, but you'll see again a lot of very recognizable names here. Get West Pharmaceutical. Now this was taken actually a little further back in 2020, but West Pharmaceuticals back then even had a very high relative safety, um, and has a great dividend history, along with Lowe's, another one of my favorite long-term dividend payers. But this is a great place to begin your search, and whatever you might be looking for is found right here. Just as we had in the growth stocks in the Unisearch tool, we have the ability to go in and to the search folders And I just want to share a couple. Again, there's more than a few, but I want to share a couple of my favorites. And here's how we look for good quality dividend growth stocks. One is called pale blue chips. Okay, you'll see here again the indicators are have a relative safety parameter here of 1.25 just to make the list. Right, you can see that line here again, this lineup. Growth rate has to be double digits at least, otherwise it doesn't make the list. That's the earnings growth rate. And then we have three different proprietary numbers that we use for our dividend evaluations. We have dividend safety. That's the one indicator in VectorVest, and here's where you find the numbers, that is not on a 0 to 2 scale. It's on a 0 to 99 scale. And we say anything above 50 is favorable. That's what we're looking for as far as a safe dividend. Anything above 50 is favorable. We have dividend growth, of course, that is the in percent per year of the growth of the dividend. Dividend yield, of course, is a standard number. That's not a VectorVest number. That is the yield and works in relation with the price of the stock, of course. And then this is the dividend paid. So most of these will pay a quarterly dividend. So for Lennar, you would take that dollar, they pay 25 cents quarterly, and that's how you collect your dividend. So that's where our dividend information. Then we combine these numbers, and just like the VST for the stock analysis on a 0 to 2 scale, we have the YSG, which is yield, safety, and growth. Okay. And again, anything above 1 would be favorable. So great search. Again, you'll see this stock T. Rowe Price I'm going to talk about in a minute, but it's on that list. That's just one search. Here's another. This is the one we have a Tuesday retirement coaching group that meets every Tuesday, and we have model portfolios built there. That ruler stock model was one of them. This is the model for our dividend portfolio. And again, this is a screenshot from the search called Blue Chip Dividend Payers. I created this search, I don't know, four years ago, maybe 5 years ago, and it's very basic. Because I'm looking for dividends, I'm looking for mature companies with a very strong free cash flow. I want only companies on the Dow Industrial, Transports, or Utilities, or the S&P. The yield has to be at least 3% just to make the list, and it also has to have a good dividend history, so it's got to come from either the 10 to 24 or 25 plus, and then finally it has to have a dividend safety greater than 50. So we come and look at those numbers, and the first thing that should catch your eye is that, well, if you're looking at this now, again, I said we shifted gears. Relative safety is not like pale blue chips was because there's no parameter on it. But I'm okay with that. Okay, I'm okay with that because again, you'll recognize again all of these stocks, I hope, and they they're more of a value company. They share their profits with their shareholders. That's why they pay their dividends out. And that's the type of stock that we're looking for that safe, steady income. T. Rowe Price, I mentioned a couple times, is another retirement stock that I own. I love everything about this stock. Again, this is now the 25-year look back. And you can see, again, what I like to call the golden staircase. From a long time ago, we used to use that phrase at VectorVest. Same thing with earnings per share. Same things with the movement of the stock. And again, without even looking at the date, this is 2008, this is October of 2018, and this is February of 2019. I'm sorry, 2020, rather. Right. But just another great company with a strong dividend history and strong earnings per share growth. And that's how we find those stocks. So that comes with the blue chip dividend payer search. So just like I showed with the model portfolio for growth, I'm going to show with income. Here again, for our Tuesday sessions, this is a longer term because I want to convey the idea that, these aren't, I could run any search in VectorVest from March of 2020 to now and show you unbelievable returns. Okay. But that's not what we do on the retirement side here. We're looking for this longer term effect and the ability to grow and collect our dividends over time. So this is a current look at that portfolio. Again, I'll talk about helping with these drawdowns in a bit. But we have 154% return. This is an 8-year-old portfolio. Started out as a 3-year model, then 5, and our coaching group just kept it moving. Again, it has a Profit Locker Pro stop criteria placed on it. Works very well. But again, just a prudent, especially on dividend stocks. We really don't want to trade dividend stocks too much. So the drawdown doesn't really hurt us as much because we know we're collecting a nice dividend from that. So same thing here. This is an 8-year look now, 8 years and 2 months to be exact. 154% return as of the other day. These are the companies currently residing there, and you can see they're all in the green. Like Lockheed Martin. If Lockheed Martin is my worst performer in a dividend portfolio, I'm feeling pretty good about that. Although it did just come in a month ago. So when we break it down, it's a 19% annualized rate of return. Pretty good. What this number doesn't include, and somebody mentioned in the chat box, this number, even though it's a dividend portfolio, this number does not include the dividend payouts. There is a way to manually enter them in here, but I'll share this with you. I have here that you would add over this time frame over $40,000 in dividend payouts. Okay. Up to about 2.5 years ago or so, I was manually entering the dividend payouts, but quite, if I'm being honest, it got to be too cumbersome, and so I stopped. I had a spreadsheet and all, but I know that at that point when I stopped, there was actually calculated about 33,000, a little over 30, almost 34,000 dividend payouts. So I'm saying you add 40,000 now, you have just under 200% gain in this portfolio, and that doesn't include the power of reinvesting those dividends. So add that to the bottom line too, and you've got another great system to generate that safe, steady income. So if you add the 40,000 again without compounding, you now have over 24% return. And if I go ahead and compare it as we did earlier to the S&P, the S&P outperformed us without the dividends, not by much, but when we add those dividends in there, we outdo the S&P 500 once again. And here's the way I like to describe this particular portfolio. It's very practical and it's very boring, right? Which is what I love about it. Okay, trades do go through if stop criteria is hit, but there's not a lot of trading that goes on here. Great companies. It's just a boring way to collect money, 24% a year over an 8-year run. Okay. And when you hear me pause, it's because I'm looking at the chat box there. But yeah, all the stocks came in 2021 is what Mark had mentioned. But of course they did, because when you see a straight line here, this means that all of this portfolio actually got stopped out, right? When one of the biggest sell-offs that in our lifetimes that came in less than a month. So there were, we went to cash and then we reconfigured. But the question is, what happened previous? Well, this is what happened. Right? This is what happened right up until then. We're up over 250% at one point. Okay, so that's the dividend portfolio. Both capital appreciation and dividend payouts. Great way to do it. What I want to do now is jump into part two of income. I'm going to spend a little time on this, and again, it's all about covered calls. I'm going to spend a couple of minutes on just defining what a covered call is, and to show you some results that you can get. And here's what a covered call breaks down to. We look at it as charging rent to stocks that you either already own or that you can buy and then sell the covered call on simultaneously, which is called a buy right. So for those of you who are new to covered call trading, here is the definition or explanation, right? You could look up covered call, you get the same answer, right? That I'm actually going to share that answer with you in a moment. But this is the best explanation, the most basic, straightforward explanation that I've ever seen for a covered call. It's by a gentleman named Lee Lowell, former options market maker. He wrote a great book called Get Rich with Options. And this quote has stood out for me. I've been using this for as long as, I don't know, as long as I can remember, at least the last 5 years, much longer than that. Mr. Lowell said, if you own shares of a stock, you have to have at least a block of 100 shares at least, and you're not selling call options against them, then you're throwing away free money. And this highlighted part here is the definition of a covered call. There are other traders out there who will give you money today for the right to take your stock away from you if it reaches a much higher price. That's what it is. Somebody's going to pay you for the right to take away your stock at a higher price. Selling covered calls is such a great strategy for padding your bank account. I can't believe there are investors who are not taking advantage of it, and frankly, neither can I. Now, let me give a more of a textbook definition of what the call option or what a covered call is. The first part is it's the simultaneous purchase of an underlying equity and the sale of a call option of the same security, also known as a buy right when you do it simultaneously. Right? You buy the stock and you write or sell the contract. Okay, those are synonymous. And of course, you can also sell one option contract against every 100 shares of stock that you already own. I'm going to focus a little bit on the buy right portion here. Okay, just a one slide quick tutorial for those, kind of a review for call options. So remember, first of all, an option is a security. It trades just like a stock. There's a bid price and an ask price. There's a market maker who is tasked with providing a fair and orderly market. Okay, so it trades just like a security. Now, the buyer, the owner of a call option, it gives the buyer the right to buy a stock at a certain price, which is called the strike price, on or before a certain date, which is the expiration date. So remember, it's a contract with strictly defined terms and conditions. Those conditions are what are called the strike price and the expiration date. That's the buyer. Now we're talking about selling call options. So it makes sense that the seller of a call option is obligated to sell or provide that stock to the buyer at a certain price by a certain date if the buyer chooses to exercise his right. Okay, so the seller gets paid, but he doesn't get paid for nothing. He takes on obligations. The buyer has rights. He paid money. He gets rights for that, and the seller takes on obligations. So we never want to be a seller of an option unless we own the underlying stock, because if you sell a call option, your risk is unlimited. Theoretically, if the underlying stock rises, goes up 20 or 30 points, theoretically your max risk is unlimited, because you have to go out into the open market, purchase that stock, and then provide it to the buyer at this strike price. That's a very risky, dangerous trade. You better be well advanced to do that trade. So we don't advocate selling what's called a naked call. Okay, that's why it's called a covered call when you already own the stock. Okay, so there's some pictures. There's, usually it shows the little cutout guys, the buyer of the call, the seller of the call. But I did a little research and I found out, for anybody who watched the Super Bowl a couple of weeks back, might remember these two guys having words, right? More than a couple of times they got face to face like this and had some words, as we saw, right? Mr. Brady and Mr. Tyrann Mathieu here, and they're arguing with each other. And I found out the NFL films are keeping the audio hidden, but here's really what they were yelling at each other, right? Tyrann Mathieu was a call buyer, and Tom Brady was a covered call seller. So Matthew was yelling at him. He says, listen, I'm exercising my call option. Now give me my stock. And Brady was yelling back at him, fine, but you got to pay me the strike price first. You got to pay me. This is my comedic pause here for just a second. It's hard doing comedy when you're on a webcast because you can't see the audience. But that's what it is, right? You have a call buyer and a seller, right? When they want to exercise their right, okay, you have to provide the stock for them. All right. Here's another way to look at it. Here's another way to look at it. This is kind of the anatomy or the step by step of a covered call. Here's, I think, a great way to look at it. So you go out and you buy, or let's say Tom Brady went out and bought 100 shares of XYZ, and he paid $60 per share for that stock. Okay, bought XYZ, and at the same time, he sold one XYZ, and this is the expiration date, 45 days out. Just understand 30 to 45 days to expiration is the window we use for selling covered calls. So he sold the 62.50 call and got paid $2. Well, what does that mean? Remember Lee Lowell's definition. Somebody was willing to pay this premium of $2 per share for the right to take away that XYZ stock at a higher price. In this theoretical example, $62.50. Paid $2 for the right to take the stock away at $62.50. So that leaves you with a net debit, right? Your cost basis now is $58, which is one of the benefits of covered calls. It lowers your cost basis. Now, at expiration, this is kind of a what if, and it could be exercised anytime during the life of the option, but at expiration, what happens if XYZ is above 62.50? Well, for a buy right, our goal is to have the stock called away. That's a good thing. So if the stock goes above 62.50 and is called away, remember our cost basis was $58. That's a $4.50 profit, or 7.5% of our initial investment, right? That's our return on investment in just 45 days. Remember, you're doing these 30 to 45 days. What if you had a monthly dividend paying stock that paid you 7.5% a month? Right? Try to look at it that way. Now, what if XYZ is below 62.50 at expiration? Well, remember, we built a cushion. We lowered our cost basis. So in this case, it happens to be 3% lower from the initial price. So we have a little bit of a cushion where we can make money even if the stock goes sideways or slightly down. Keep in mind, though, if the stock does go below 58, losses will begin to occur. It is a bullish trade, the covered call. And the risk is inherent in the fact that you own the underlying stock. It has nothing to do with the fact you sold the covered call. Right? You own a stock, that's where your risk is. That's why most mainstream brokers, you don't, the lowest level of options approval, sometimes you don't even need approval to sell covered calls because it adds no risk to your portfolio. I remember when I took my Series 7 back in '92, the only option trade you could ever do in an IRA was a covered call because it added no risk. Nowadays you can do a lot of different trades. Okay. All right, so that's the anatomy of the covered call there. Here's a screenshot from our Options Pro software. This is of a recent trade. This is an actual trade we've done recently that was actually closed with about a $425 profit. I use this screenshot to show the important numbers. You have your break even or your cost basis, right? That comes, you in this particular case for Micron MU, we paid 82.88 and then sold a call option and took in $3.14. That left us with a cost basis of $79.74. Somebody paid me $3.14 to take Micron away from me at $85. So our max profit there is $526, and we get the credit of $314 is just one contract, so it's $314. Okay, so that's just a quick view of some of the numbers. Okay. Now, don't worry about all the numbers on here. I'm showing you this for a reason. This is from the year 2020 from our retirement coaching group. I keep a diary. I do it on a spreadsheet, right? Sometimes it's easier than going back into your broker. It's just a way to track some trades and see what happened with them. This is every trade we did in our coaching group for 2020. There were 38 trades, 29 of which were profitable, which is just about 80%, just a notch below 80% winning trades. and we had just over a 25% annualized rate of return for the year. We had just over 25%. The reason I'm showing this is because I want to focus on one particular trade. It was the AMD, which turned out to be our MVP of 2020. Every trade we did in AMD, every buy right or covered call trade we did was profitable. The reason I'm showing you this is because I just wanted to let you know where these are real trades, live trades, and I'm going to illustrate them for you here on this graph. Okay, so AMD, here's what it looked like. And I'm going to scroll through this kind of quickly and give you the narrative. Started back, well, actually, we did this in 2019 as well, but for 2020, we started on February 4th. We went out and purchased 200 shares of AMD and we sold two covered calls against it. Okay. 14 days later, we closed the AMD position for a profit of $538. We closed it because we had a profit target set before we even hit the enter button. Okay, so our process, our trading plan netted us that's almost 6% in 14 days. That's how we kicked off the year in 2020. Now I'll just continue to scroll through. We did it again in May, made another $894. This time it was 9% in 35 days. Right? Our process, our weekly process, had us buying, and we bought other stocks in between. But we bought on June 16th, we did the same 200 shares, two covered calls, another $616 in 24 days, 6%. Did it again in August, another over 7% in 28 days. Right? We did 8 trades throughout the year. They were all profitable. Okay, another almost 8% in 20 days. And then I'll get through this just to show you. This is important to show you the power of generating the steady income. Another 6.6% in 14 days, and then finally we did another eight days. It took us just to get to almost 5%. Then finally we did a trade on December 8th. We actually closed it on January 11th of 21, but that was another $1,200 or another 7% in 34 days. Okay. That's just a quick run through of following a process in our Tuesday coaching group, the way we teach the specifics to do it. And remember, we did 29 out of 38 trades. It wasn't just AMD, with some great returns. It was over $7,300 just on AMD alone. Okay, so that's what comes from this spreadsheet. Again, just under 80% winning trades with a 25% return for the year. So that's just my way of illustrating. And then this is our new year. This is 2021. We've had 2 round trip trades so far. Again, just doing either 100 shares or 200 shares depending on the stock. And this is with a portfolio of only $50,000. Okay, so if you want, I don't know the size of everyone's portfolio. Everybody has a different size portfolio, but this is with a portfolio of as little as $50,000 to generate that kind of income. Some folks will do 500, 600, 700 shares, sell 5 or 6 or 7 calls, and make even more. Okay. While I have you here, this week's special presentation I'm doing on covered calls, so I invite you to give you a quick preview because you were kind enough to be here. So we'll do that. Yeah, John answered the question. I happened to look over. Richard said that 220 was a special year. Yeah, it was special, right? We had a huge drawdown. Our process kept us out. We didn't do trades during that drawdown. 2019, as John wrote in the chat box, were very similar returns. 25% is at the high end of the return. I will grant you that. But we're well above. We're in the teens and well into double digits the last 2 or 3 years. So, let me ask you this. Richard asked that question. If it was 18% or 16%, would that not be real? 2018 S&P 500 was actually down, and we had in the teens for our returns. The lower to mid teens in our dividend portfolio. This is not trading. We're not looking. This is not a get rich quick scheme. You're not going to double your portfolio in 6 months. Okay, that's not the goal. But a great question. I appreciate the question. Yes, 2020 was a really good year, but and yeah, there you go. Yeah, 15% in a retirement account would be a wonderful return. All right, great. Let me keep going because there's a couple more points I want to make. I want to talk about protective puts. Okay, again, I'll say the same thing. Don't if you've never traded put options before, don't worry, because I know all of you in this room understand insurance policies. Is my guess. I'm going to guess that. Protective puts are nothing more than an insurance policy to protect your assets from any damage that might occur. Okay. We talk about protective puts. I was drawn a long time ago to a quote from my fellow Connecticut Yankee, Mr. Mark Twain, and he wrote, "Don't just sit there and worry, be proactive. Do something, anything about what's worrying you so that you can gain information, focus, and control over the situation." Okay, that quote has stuck with me for a long time, and it relates to exactly what we're talking about here. Because if you're not worried, this is what happens to you, right? I think about the old cop. I worry about everything, right? I think about the old cop. I look over my shoulder. I look around every corner. I check every room. I worry about everything. If for the guy with no or gal with no worries, this is what happens if you're not prepared. Okay. So let's talk about protected puts. We reduce risk. Buy put options to protect individual stock positions or your entire portfolio using the SPY. Now, you can use what's called option collars on individual stocks to protect positions. I'm not really going to go into that. It's just a combination of a covered call and a put, but I'm not going to get into that one right now. The goal here is simple, and it is to protect your assets. Right? As Ray Dalio said, you can make money, you got to take risk, but you can't keep your money if you're not strategically defensive. So, look at it as insurance. You insure your home, your health, your life, your car. And as I always say, my wife and I, we have insurance policies on our dogs. Right? We insure everything. That's what a protective put is. Now, I talked about calls earlier. Just a quick note. Put options, the owner of a put has the right to sell units of 100 shares of stock at a certain price by a certain date. Remember, call options give the owner or the buyer the right to buy, to call away stock from someone else. A put option conveys the right for you to put your stock to someone else. If the price of the underlying stock goes down and you're long a put option, the value of that option will increase in value as the price of the underlying falls, like an insurance policy. I'm going to go through this case study kind of quickly here. Texas Instruments. Don't worry about the date or the stock or whatever. It's the message I'm trying to get across. Okay, here's the setup. This is a scenario. You bought Texas Instruments in November because the overall market was bullish and it's a good quality stock. Maybe you bought it way back here on this confirm call. Maybe on this one. For our purposes, it's this one, just about $100, give or take. Okay, this is the scenario I'm setting up. On January 17th, you have a gain of 20%, roughly $2,000. Okay. Now, the mindset you have to understand and to appreciate the power of put options is this. Yes, I know your cost basis is about $100, but I want you to look at it differently. I want you to look at it as though you paid or you own the stock now at 120 because you do. That's where it's trading. You own the stock there now. Now, of course, listen, can it come down a little bit and draw down? Yeah, but that's my money now. That's my stock, and it's incumbent upon me to protect it. So, what do? Well, because we do our due diligence on all of our stocks, we know earnings are announced in about a week. So, it's that window of a week to 10 days before earnings. We like to be proactive. Okay, so it's time to be proactive and become defensive. What could you do? Well, one thing you can do is buy insurance on your asset. In this case, this theoretical case, you went out and bought one put option with a 120 strike. That's an at the money option, and you paid $4.23 or $423 to insure a just about a $12,000 asset. And there's strategic reason for it because earnings are coming out. Well, why do we do it? Because when earnings were announced, Before the bell, the stock gapped down, right? Your $120 stock is now trading down below 110. And the value of your insurance policy or your put option has gone from 423 up to 1128 as of the close of that day. So what happened? Well, had you not done anything, yeah, you'd still have a profit, but you just gave back $1,000 when you didn't have to because you were proactive, right? The $700 you made on the put option offset that and mitigated your drawdown. It's a very simple thing. Buy an at the money put or slightly out of the money as an insurance policy. Value of the put rises, it offsets the damage to your asset. And for those who might say, well, what if I buy the put and the stock goes up? Well, you close the put option and you might lose a couple of $100. But it's the cost of doing business. Again, this is not your day trading account. This is your net worth with the number one goal of protecting and preserving it. So I always use the analogy. I open my bank account and I look and I have the ACH that goes right out to Geico. We use Geico. And I see it goes out on the 18th of every month. And I don't look at that when I'm doing the books and then say, I don't get mad because a tree didn't fall on my car this month. It cost me a few bucks, but when you need insurance, it's great to have. That's the mindset I need you to have to understand this. Okay. Um, I want to finish up on a few points here so you don't have to type in, but I know the answer. If you had the ability to preserve your capital through strategic times, I know you'd rather have an insurance policy and the ability to mitigate losses than to do nothing and hope that your portfolio didn't go down a lot. So you don't have to type it in. But I know that's the answer you would have all given. Let's talk about case study for a market correction because I talked about individual stocks. It could be an earnings report. It could be some other headlines. It could be, whatever. But you also you can protect your portfolio by using, put options or defense on an overall index. And what we use is the SPY, which is the ETF that tracks the S&P 500. You could use any of the major indexes, but I choose the SPX or the SPY again is the ETF. Story behind this screenshot, I was building a presentation. This was right before the pandemic sell-off. This was a totally different presentation I was getting ready to do. And I was getting ready to make the point of how important it was to protect your portfolio when the time was right. And people were always just the way they are now. The market's going up and everything's, just skyrocketing. But don't talk to me about that unless you are going to also talk about what happened back in 2018 in October. This day and age, it's forever ago, right? But I remember it very well. The market basically crashed just about 20% in 3 months. That was a huge move to the downside. And then it took off. But it took you almost a year to get your money back. Yeah, it spiked above it for a little while, pulled back. But if you did nothing, you wasted a year of time, use of your money just trying to get back to even. Then the market took off again. Well, you don't have to suffer through that catastrophe as Mark Twain talked about. Here's a current. This was like yesterday, I guess. I took the screenshot, right? So I'll say the same thing as I was building it last time. Don't don't talk to me about this move to the upside without remembering what could happen. Right? This was the February meltdown, and yeah, I know it was for a very specific reason, but October 18, we didn't have a pandemic. Here was another pretty good drawdown in the market. So what I've done here is I've zoomed in to the SPY. This is October. I'm sorry, February of 2020, just about a year ago. Our DEW timing signal went to a down situation. It's a VectorVest market timing signal. What do? Well, you don't ignore it. You become defensive, and you can buy puts, just like we did on an individual stock on the SPY. Just 4 days later, the confirmed down came on the 28th of February. That's our last line in the sand. So you could have gotten defensive here, but I prefer the DEW. Become defensive. Buy some puts. Here's what would have happened. This is puts for portfolio protection. So I've zoomed in again. On 224 of last year, the DEW timing signal went to a down situation. That's a great time to buy a put option, an insurance policy. So this is a theoretical trade on this one. You buy one SPY put. This was back. You would have bought the. I would have bought the April expiration. It's an at the money put. The SPY was trading at 322. You would have paid this is the closing price. You would have paid around $9.75 per share, or $975 for one put option, which theoretically would protect your portfolio. If the SPY went to zero, you would make about $32,000. So if you bought three of them, you would protect your entire hundred. I'm using a theoretical $100,000 portfolio. So what happened? Well, I took it out to the first day that the market started to move up a little bit, and not even a month later, that same option was now trading at $71 per share. Now I know this is a dramatic move, but this is when we need them, and we didn't have to guess that it was going to happen. We had the signal. That's over 6 grand on just the one option, and that's how we mitigate the drawdown that I pointed to earlier on the equity curve in the growth and dividend portfolio. I did the same thing here. I'm gonna scroll through this one kind of quicker. If you had used the confirm down, it still would have been very helpful. You would have gotten hit a few days here, but you still would have had, for just the one contract, over $5,000 return. Okay, these are quick illustrations to show you the power of an insurance policy on your capital, on your net worth. And remember earlier I pointed to, this was the ruler stock. So October of 18 and February of last year, uh, would we cover it dollar for dollar? Probably not, but we would cut that drawdown at least in half, if not more. And that goes to growing your portfolio even more than just having stop criteria. Okay, so those are the three core strategies. We talked about ruler stocks, and I showed the return there, how we almost doubled the S&P performance. I talked about the power of income using the blue chip dividend payer search. And when you add dividends and you compound it, how we can beat the S&P 500 there as well. A very practical, very boring portfolio. And then I showed you all of the trades on the AMD, just that one example, over $7,300 just on that one stock. And then we talked about mitigating these type of drawdowns. Okay, so it takes us to where we began, what Dr. Delito said. How do you keep from running out of money in retirement? Just keep making more money. And so it is with that goal in mind that I would like to invite you to attend our Ultimate Retirement Solution online course. If you're interested in learning more of the specifics and the techniques that I just showed, we would love to have you sign up for the Ultimate Retirement Solution online course. Just stay with me for about 5 more minutes, and I'll go through the modules, and there's some great bonuses and resources that come with this. So just stay with me for 5 more minutes. If the first module is all about laying out a clear objective and goals. You're not going to be successful in retirement if you don't have a clear path. Module 2 talks about a stock buying checklist, balancing, allocating your assets, and setting up your risk management plan. I talked about the Profit Locker Pro. We'll go into great detail on how to manage that portfolio. We shift gears and start talking about dividend growth. Okay, the dividend growth portfolio, where we identify those stocks, and again we set up our risk management program. Now, modules 4 and 5 to me are worth the entire course to begin with, and we're already giving the course away at a great price. But to me, if you're not familiar, or if you are and are looking for a more specific plan, module 4 will walk step by step, A to Z, the what, when, and how to set up and how to manage the covered calls that I was talking about. The AMD call I showed, it was just one of many, and I showed how we got out of that trade before we even hit the enter button. We knew what our profit target was and got us out of the trade. Strategic defense. This is all about ensuring your portfolio, the signals that you can't ignore so that you can be strategically defensive. Right? The SDS, it's, remember back, the Star Wars system? This is what I likened it to. And then finally, Module 6, we'll walk through just managing your portfolio, actually showing how to enter trades, talk about portfolio automation, and round up everything we talked about in these first things. Now, there's a lot more that goes with that. Okay, that is in the VectorVest University. It's 6 modules that are recorded, and you have access to. If you sign up tonight, you'll have access to all 6 modules later. But what we give as a bonus are 6 live mastery sessions. So you watch and learn from the module. We then have a live session every Monday at noon, starting March 1st, where we will implement what you learned. We'll review it. We'll actually implement it, and while the market's open, we'll look at what you're doing, help to guide you. And if you can't make the live session, don't worry. We have a dedicated email bin. You can send us questions, and everything we do is then recorded and added into the university along with the modules, and it's archived there for you to watch if you can't make a live session. Okay, the other thing we give, this is my favorite thing. I mentioned earlier a couple of times about the retirement coaching group that meets on every Tuesday. It's a separate group, but we invite you as a student for the URS course to come and watch the techniques in action. We go through our dividend, our growth portfolio, our retirement income portfolio, and we just analyze it. Do we need to protect any stocks? Earnings season was here. We had to protect some stocks. And then if the market bias is bullish or up at all, we'll go ahead and walk through a very specific process of doing the covered calls, the process we use for the 80% winning trades that I showed you in 2019, or I'm sorry, 2020. So we'll invite you for the life of the course. You can come every Tuesday. We'll also record that and put it into the resources for you if you can't make it live. And then finally, after the 6 modules and the 6 mastery sessions, our friend and colleague, Mr. Ron Wheeler, will teach a course, a module on trading spreads for monthly income. It takes it to another level using credit spreads, high probability trades, and he does a great job introducing you to that. If you're in the room and you're interested and you're currently not a VectorVest subscriber, we'll give you access to the tool for the life of the course. It really is the best tool to determine market direction and find stocks, and it'll save you a whole bunch of time using it. So if you're new to the course. Now, all of those things kind of a la carte are going to cost you a lot more money. Right? This is what those things are worth. The training course, the mastery sessions, right? It adds up. But the Ultimate Retirement Solution course, we're going to give you a great bonus here. If you order, John and I are going to stay and answer any questions as long as there are people in the chat room. So if you order between now and even after we're done, the special price will be up there for a while. Our early bird special is $5.95. Because you took the time and you're here, we're going to give it to you for $4.95. Okay, just $495 for the 6 modules, 6 live mastery sessions, a bonus session, and 6 other live bonus sessions in the coaching group. That's a lot of resources, and we dig deep, head into a lot of details. Just go to vectorvest.com/URS. In fact, you can just click on it now. John has entered it into the chat box where you can just click on that, which I'll do in a minute and walk you through it. But this is a great bonus. The regular price of the course is $9.95. What we call our early bird is $5.95. But we're going to take another 100 off for you. Okay. Now here's the big thing. We talk about risk involved in trading and investing. There is no such thing as a risk-free trade, but this is, right? This is a risk-free trade because if you take the course, right, go through the work and you decide at the end that it was not what you were hoping for and you're not satisfied, we'll gladly give you a 100% money back guarantee. Okay. And Jim, I'll get to the exact dates in about 2 seconds. This is the key. It's a risk-free trade. We will build a foundation for you to grow and manage your portfolio, learn how to generate income, and most importantly, how to protect your portfolio. I showed you the AMD trades. It's one AMD trade. Right? That's one covered call. Right? That's all it is. And it's guaranteed. You can ask yourself, I'll ask, but you more importantly, you should ask yourself, how much is it costing you not to do this? Right? How much money might you lose doing it the wrong way? How much potential profit will you miss out on? How much time and energy will you spend trying to do this on your own? Then ask yourself, well, listen, how might life be different if I do this and it actually works? Which I know it does. It's never too late. They say that the best time to plant an oak tree if you want to enjoy the shade is 20 years ago. The next best time is today. It's the Ultimate Retirement Solution course, Protect and Grow Your Retirement Nest Egg. 495 is the fast action bonus. Now that's going to be available to you for a little while, so you have to think about it when we finish up the webcast. It will be available to you. If you do go on there now and you type in and click on the box, I'm going to go ahead and do that now. If I click on the link that John put in, if you do go in there, just type in the chat box that you're in. That I want to know that you were successful in getting through to the site. But here it is. Enroll today. Just 490. You'll even get Adam on here to ask you questions if you have any questions. That's our live chat box. But you scroll down, you'll see all of the things that I just talked about that are available in the course and the bonus sessions and all of the things that are there. So 495 is the price. I would love to have you join the coaching group for the 6 weeks, join the course and the live mastery sessions. I look forward to you doing that. Before I have John come in and help me with some of the questions that have come over, someone asked about the dates. Now, here's how it works. If you sign up, as soon as you sign up, and just a little while after, you'll get an email from us giving you all of the links and instructions to access the course, which I'll also show you in just a second in the university at VectorVest.com. So here are the live sessions. So you'll have access to the 6 modules and all of the other resources. The live sessions start on Monday, March 1st, and they are every Monday right up to April 5th. This is at noon Eastern Time. And then the Ron's bonus session will be Monday, April the 12th. Okay, so you have access to all the resources tonight. You'll have access to them. And then we have our live sessions. And so at this point, what I'm going to do is log in here. And while I'm doing that, I'll ask John to come in and see if there's any questions or comments that I can address and help you guys with. Okay, hey, John. Here's the dashboard. This is the university at vectorvest.com. And John, before we get, there's Adam again. And before we get to any questions, let me just show you what it looks like. Did I pass it? Here it is. The Ultimate Retirement Solution course. So when you sign up, here's what it looks like. You get first a welcome video, then you get module 1, the presentation, the mastery session. We have homework assignments. We have a video created to help walk you through that. Okay, so again, these are recorded. The mastery sessions are in there from the last launch. What we do on March 1st, we'll do mastery session number 1, and then we'll put that in there and have the most recent one in there. All of the modules, the bonus module, and then here are the retirement coaching groups that we archive for you as well. All right. And then here under resources are all of the slides. You have access to the PDFs. You can download all of the slides from each module and have that all available to you. VectorVest.com/URS. Okay, John, how we doing? Any questions that I can help with? Anybody type in, I'm in yet? Let's take a look. Who's in? Who's taking advantage of it? How long do those sessions go? Great question. The modules are about an hour each. Again, you have access to those; they're recorded. The live mastery sessions usually run from an hour to a little bit longer. I think the longest sometimes I get going, and it could be up to an hour and a half, depending on which module and how much information to cover. So the module mastery session 1 is a little bit shorter because it talks about the introduction, but by modules 3 and 4, there's a lot more information as we build through this. But about an hour to an hour and a half. Again, all of them are archived. And if I don't know if I mentioned this, Remember, from the end of the course, when the course is done, you have access to all of what I just showed you in the university for one full year, by the way, if I didn't mention that. Okay.
Excellent, Jim. Next question. Actually, have Richard from Canada, and actually a few other people from other countries asking if the content is applicable to them.
Yeah, it is. Um, it is the first four module, the dividend and growth portfolios and all of that, uh, overlaps with all of our UK, Australia, Canada. The only thing I mention when we talk about that is the um, the option markets can be a little less liquid than in the US. So if you're doing covered calls, that's not to say there are not candidates. There are still large companies and good quality companies that you can sell covered calls against and buy puts for insurance. But the only thing I mentioned there is that the option markets are a little bit different. So just be aware of that. Doesn't mean you can't do it, just a little less liquid than the US side. But everything else overlaps perfectly.
Jim, a few people are asking about this.
Mhm.
Are they going to get VectorVest 7 and for how long?
Yeah, everyone, if you're not a current subscriber, you will get access to the VectorVest 7 and end of day, I believe it is, the end of day version, which is all you need for 60 days, for the life of the course, just so that you can go through what we teach in the course and what we do in the mastery sessions. After that 60 days, you'll determine whether you want to continue with VectorVest. Um, this is always, listen, the question is, do I need it after the course to do what you teach? The short answer is no. Do I personally think it is an essential part of what we do? The market trends and finding the right stocks? Yes, but you don't need it. Hey, Pierre said he signed in. Fantastic, Pierre. Thank you. Oh, and John, I just saw Richard's question come in. What I didn't mention, what also comes with the life of the course, not for the whole year, but for the life of the course, you do get Profit Locker Pro, Richard. I forgot to mention that earlier. So you get access to it for 60 days.
Excellent, Jim. Can you give them an idea of pricing? So the deal that they have right now, when do they get it for? And when does the price change? Stuff like that.
For the course itself,
Yeah, pricing for the course.
yeah. So here's how it works. Right now and through most of this evening, right? Usually it shuts off when we end the webinar for most folks, but I push to keep it open for a little while. So you're going to have access to this evening, right? Tomorrow morning when you wake up, this it'll be back to 595. I want to say it's February 23rd. The price of this goes back to 995 on the 23rd. Now, as far as when the course itself launches, there's no the course for you launches as soon as you sign up. You have access to the course material. Okay, so that's when it starts, and you have access for a full year from the end of it. But you get 495 through tonight. Tomorrow you'll wake up, it'll be 595, and then on the 23rd it'll jump to 995. That's how that'll work. Hey, hey, John, I see Jim's question just came in there. Could it be because he's not a subscriber? Does he need to call in?
I don't know what the issue is, but either way, I'd suggest calling in so they can be able to figure that out if you can.
Yeah, anybody who might have issues with that, I just typed in the product support number. It's 888-658-7638. You can give a call to product support and they'll get you signed up at that special price. Um, I know you're probably doing the same, John. I'm reading through. I just saw Carl's question come up. I'll comment on this. He says, "Does the access to the coaching group start right away?" And that's a great question. I wasn't clear. You will be invited to the coaching group starting on March the 2nd, which is the Tuesday after our first mastery session. So you'll come. So this is every Monday are our mastery sessions. I should have added it to the slide. I'm sorry. The coaching groups will be March 2nd, March 9th, March 16th, 29th, and then I guess April 6th. Okay. So the invite will begin. Your access to the coaching group will begin on March 2nd. Mark again, the number is, I'll type it in for you, 888-658-7638. That is oh, John typed it in as well. Okay. Be a little patient with the folks on the floor. If you got to hold for a few minutes, that's, yeah, let me do this too. I'm going to go ahead and do this, Jim. I just put my email address as my direct email address. If you have trouble logging in, if you have trouble getting through, whatever, shoot me an email. I know you were here. I'll make sure you get the price. Okay, so if you need to do that. Okay, so that's my direct email. If you have questions or issues trying to sign up. Carl's asking or saying he took the options jumpstarter course. Does this course go into covered calls more deeply? Yeah, Carl, the options jumpstarter course, we did have a bonus module on the covered call, but we'll spend a lot more time both in the module 4, also where you're going to get a lot of information and illustration of the covered call is from the Tuesday coaching group. We do a lot of the covered call process during the coaching group. So the short answer is yes, it goes much deeper than options jumpstarter did. Dale's Dale, I know John commented there. He was asking about an options pricing module. I do not have that currently. Dale, you do actually. There is an options pricing model found right here. If you click on tools and go to options pricing model, it's not something we really get into, but because you asked, just so you know, you do have access to it. If you right click, on any stock, it'll read as calculate option price. It'll read a little differently. Everyone who has VectorVest has access to this. It's basically just the Black-Scholes pricing model to give you a fair value of the option that you punch in there. So the short answer is that you do have access to specifically the options pricing model. But and John's right. Other than that, there is no option. Now in the coaching group, in the coaching group we use what's called the Options Pro software. Right, we use that to help find our candidates and scan through and find the best covered call candidates. But that's not part of the course. That's part of the coaching group. That's a separate entity there. But you'll get a look at it and how it works if you join up.
Hey Jim,
Mm-hmm.
question from Richard here sparks two follow-on questions.
Mm-hmm.
And the question really is, how much time will they need to spend per week on learning the material? And then further from that, how much time do you think they will need to actually follow through once they're done with the course?
Yeah, that's a good question. Listen, in the beginning, I wish I could say, hey, it's 5 minutes a day. It's so easy. You'll get it, overnight, and everything will be fine. It's not that easy, but by any stretch, it's not very hard. So how much time do you have to put in? Look at it this way: you have a 1 hour module per week. You have about an hour long mastery session, and then we have about an hour to an hour and a half long coaching group. Okay, that's what comes with the week. So there's 3 or 4 hours right there. So look at it as you were going to college, right? You're taking a course. So 4 or 5 hours a week, right? The URS course does, it talks about covered calls, protective puts, building and managing your portfolio. A lot of the building and managing of the portfolio, especially building, is pretty straightforward. So it really shouldn't take too much time after the mastery session and watching the module to implement those. The covered calls, if you're new to covered calls, it's the easiest option trade there is. It's the most popular and the easiest option trade there is. If you're familiar with buying stocks and selling stocks, once we get in, now I gave what I hope was a decent overview of the covered call, but once we get into a process and you start seeing, okay, here's the checklist, here's the step by step, here's the trade setup, and here's the trade management, it'll come pretty quickly to you. Okay, let's see who else is in. Anybody else sign up? I just want to make sure you keep a lookout for the email. Once you sign up, you will get an email giving you all of the instructions that you need, any link or any information that you need to access the course. Remember, you sign up now, you get access to all of those resources tonight or tomorrow, whenever. Well, it'll if you do it now, you'll have access tonight. So, Richard says, so after the training, managing the portfolio, is it an hour a day or more? And absolutely not, Richard. It is not. Let me give you a quick look here. I can show you in my VectorVest program. These are the current. Now, our resolution for webcast bunches up my screen, but you can see. I hate when it does this. Hang on, let me drag that back over. So you can see here's the current blue chip dividend payer portfolio. If I break that down, this is what I showed. All of our positions are in the green. They're all doing very well. You can sort them by return on investment. You got the dividend yield and the payout here, and you can track the progress. This is a 2 year old, well, almost 3 year old version of this. You've got ruler stocks, which is basically an automated portfolio. Right? We use Profit Locker Pro. It's all set up here. You'll have access to Profit Locker Pro. This is when I said customized. I'll take a minute here to illustrate this to you while you guys are here. Right, we have default settings for prudent, conservative, aggressive, or prudent, conservative, aggressive, or speculative. I take the prudent one or the conservative one and I just adjust it a little bit. I change the target price. I don't want to go into a whole lesson on Profit Locker Pro, but there's ways to adjust this. This is just nothing more than a prudent stop criteria that works really well for dividend payers and for ruler stocks. So you do have access to that, and I'll teach you and show you exactly how to set it up. And that's the current portfolio. So it does not take long. No, it doesn't take an hour a day to do this, right? You'll have these portfolios set up, and you'll be alerted, right? We have alert system to let you know when a stop criteria is hit and that you have to act. Now, for the buy right portfolio, it's nothing more than, what we do is we set the stop order as soon as we enter our order. So you don't really even have to watch that every day. You can, and we become a little, we tweak some things during the life of a real world trade. You might take profits a little bit earlier, you might cut losses a little short. We don't divert from our process. But if I'm looking at a down market or a toppy or nervous market, and my profit target is $1,200 on a trade, and I'm up 1,000, I'm not breaking the rules by pocketing my $1,000. That's the kind of subjectivity that comes. But no, hour a day, no, you don't. You definitely don't need once the course is over. Nicolay, thank you so much for registering. We look forward to seeing you there. Keep an eye out for that email.
Hey Jim,
Yes.
I've noticed this question from a few different people.
Mm-hmm.
Those portfolios, do they build them from scratch?
The short answer is yes. The portfolios I just showed you are not going to automatically be built into yours. What the modules? Excuse me, I have to sneeze. Hang on a second. Hey, chew. I'm sorry, I had to sneeze. The modules. This is where you'll learn how to do this in the VectorVest program. There's resource video. Well, that's not. There, in the module there are The modules themselves teach you how to build a portfolio. The mastery session. In the mastery session, I will go over again how to do this. Right? I'll show you. You can do it from a back test. Right? I have all of these things back tested. Right? I like to group these by the search, and I can show you all different back tests and things like that. Okay, you can convert these into portfolios, or you can simply start the portfolio from scratch and just set it and turn what's called the Genius or the Portfolio Manager on, and it automates all of it. But all of that, so I guess the short answer to your question is this doesn't automatically appear once you join. What you will get access to, by the way, is the watch list, I'm sorry, the trading system viewer, which will allow you to come in here and automatically build, let's say, the blue chip dividend payers. That's this portfolio right here. Right? If I scroll over, you'll see you need to have taken this course to have access to it. Okay. And then you simply, it gives you the trading system details. You can build the portfolio right from here. So all of that's gone over in the modules and in the mastery session. Okay. Hopefully that helps. And so that kind of goes to Gerard's questions there, right, John? So, yeah, we're that's what the modules will do. It will show you not only how to build them, but how to manage them and how to set it all up in the VectorVest program to make that easy.
I'm just looking through here to see if I missed any.
I see Dale typed in there. If I'm reading it right, one more question. I am good with VectorVest. Need help using? Well, Dale, here's the great part. You have the lot of answers to this question. First of all, that 888 number, product support, is we're there from what, John, is it 7 in the morning till 11 at night? So if you have a functionality question or a navigation question, you can always call them. In With the course, you have, when the email that you receive, you'll see you'll have a dedicated email bin. You can send questions in, and we do our best to get to them as quickly as we can. You have the mastery sessions and the chat box, just like we do here, to ask questions. Okay, and that's the whole core of what we're doing, is to show you how to use VectorVest to implement the strategies that I talked about today. Everything we do is to do that. And well, great. Dale says he signed up. Now we have to help him deliver. And Dale, listen, I but between John and I, will be there on the masteries and in the coaching groups. We do our best, and we've been doing this, this course and this session and the coaching group for, time's going by. It's been, well, I've been here 14 years, but we've been doing the coaching group. What I'm saying is we'll do our best and we'll get you there. I think we'll build a foundation that you need. Great, thanks. Gerard, the number to call is, I'll type it in there for you again,
I
six.
think he's in the U.S.
Uh, then I don't know what to type, John. Sorry.
Yeah, what country are you in, Gerard?
Yeah. Dale says if it works, you should be retired by now. Well, Dale, it all depends where you're at, and that day's coming. It's coming sooner than later. We enjoy what we do. We practice what we preach. We make money doing it, and the day will be here when there'll be somebody else talking on this end. But we enjoy it. Everybody's got their target. Everybody has their number for when they retire. Some folks here accuse me of acting like I'm in retirement already, but Gerard's in Belgium, John. He's in Belgium.
Yep, I just got that.
Ravindur. Let me see what in your commercials they say don't trade blind. VectorVest tells you what to buy, and when to sell. They show you here is the sell signal before the pandemic, and here's the buy signal around March of 2020. So what do they mean? Well, dear, the answer is pretty much in your question. So we have market timing system, right? Here's exactly what they mean, what we mean, what I mean, what John means, right? What Dr. D meant when he created the program. This is a market timing graph. Okay, everything we do leaves a footprint for 25 years. When we said the market was rising, going down, when you needed to be defensive. This does not predict the market. Okay, this recognizes trends in the market, tells us where it's trending. It doesn't predict where the market's going. Okay, this is the confirm call signal. So to use your dates, right? Let's zoom in. Where was? Oh, I got to go back even further. Sorry. Here's the drawdown right here. So as I was saying earlier in the session, on October 4th, whoops, I want DEW. The DEW on the 24th, rather. I keep saying October. On February 24th, the DEW signal went down. Did we predict it was going to be that big of a drawdown? No. We didn't have all the information on the pandemic yet, but a 25-year-old proven over time market timing trend told us that we need to be careful here. That there's a signal that's showing us that this may be an overbought market and we need to be strategically defensive. Now, if I scroll to the one right before it, you'll see it lasted 2 days. There's a whipsaw. And that happens, and we know that happens, and that's fine. But what you don't want to do is ignore it and have this happen like it did in 2018, like it did in 2008, like it did even in these areas here. You would have saved a lot of drawdown here by being protective. So we don't predict, but what we mean is the VectorVest timing signals are telling you when the market has found a bottom and is beginning to rise, or when it's found a top and you need to be defensive, right? That came on March, what day was that? Actually, April the 6th. The March 23rd low. And we have even more aggressive signals. We have the primary trend would have got you in way back on the 25th. Green light buyer would have got you in on the 26th. Right? But we're more prudent and conservative here. So we would have gotten in either on the 6th, or for our investment plans, we use the confirmed up call. So that's where we got in. All right. Gerard says, when does the red signal appear? Well, I don't want to get into a whole market timing module here, but I'm happy to show you real quick. Here's, you know what? We're here. There's a few people left. Let me just do it real fast. Confirm call. How do we get a confirm call? We get a confirm call when the price of the VectorVest composite goes up week over week for 2 consecutive weeks and day over day. 1, 2, 3, 4, 5. That's 1 week, one trading week. 1, 2, 3, 4, 5. It was higher here and higher here. Not only that, it was up day over day, and what we call the buy sell ratio was above 1. When those two things happen, we get a confirmed up call. Confirmed down call comes when the market goes down week over week for 2 weeks, down day over day, and the buy sell ratio is below the 1 number. That's a quick lesson on the confirm calls. Okay. Week over week for 2 consecutive weeks and day over day. That's what happened. It went up week over week for 2 consecutive trading weeks and day over day, and the buy sell ratio was above 1. On this one, it went down 1, 2, 3, 4, 5. There's 1, 1, 2, 3, 4, 5. Week over week for 2 consecutive weeks, day over day, and the buy sell ratio below 1. That's how we get the confirm down. Ravinder, did you sign in? Ho- Hopefully that helped when it says when to buy, what to buy, when to sell. That's the essence of a trading plan. Yeah, what I just showed you is our market timing graph. That's built into VectorVest. So you do get that. If you're not a current subscriber, you get it for 60 days. That's part of the $495. And don't forget, you have you have access to the program, the VectorVest program, for 60 days. You have access to the resources in the course for a full year. Right? So if you want to continue VectorVest, there is a monthly fee, but you know I'm a little biased, but it's worth every penny. Oh, great! You did sign in. Fantastic. Well, we look forward to seeing you. I think a lot of your questions will certainly be answered when you start the modules. And like I said, keep an eye out for the email. All the instructions will be there to get you logged in. All right, Gerard. If you have any issues, I put my direct email there. You let me know, and I'll make sure you get the price. JimP@VectorVest.com. And Eleanor, yes, you'll actually should receive um, a version of this presentation a little later on, the replay version of this. Yes. All right. Still a few people in the room. You're welcome, Gerard. I'll kill a couple of more minutes here, and I'll chat if there's any questions about the course or about anything else we talked about. If there's any questions at all. For those who are still here, join. If you're a subscriber, I'll be talking about covered calls again in the special presentation this week. So if you have the time for that, join me for that. Richard says he just joined. You just got into the webinar now, Richard. He says he previously took the course and it's great. Richard says. So there is a vote of confidence for those who are still in the room debating. Richard said he took it and it was great. Thank you, Richard. Pierre, thank you. All right, gonna give it another minute. Yeah, Richard, great. If you want to take it again, that would be great. Shoot me an email if you're going to. I'll just type my email in there. See what I can do for you. Remember that for whoever's left in the room, and I'm going to wrap it up here, it's money back guarantee on the course. If you're not satisfied, we'll give you your money back. That's number one. Number two, remember the price does go up on February 23rd all the way up to $9.95. So it's $4.95 now throughout the rest of this evening. Then it'll go to $5.95, and then Tuesday I think is the 23rd, if I'm not mistaken. It'll go up to $9.95. Oh, Richard, you're up in Danbury. Fantastic. Yeah, that's a couple of towns over. Yeah, that's where my. Okay, I'm really going to give you guys 30 more seconds. I'm going to tell a story for Richard, who's from Danbury. Danbury High School. Brian McMahon High School is where I went in Norwalk. I was the starting quarterback, second game of the year. We're playing Danbury, and tore up my knee. It was the last game I played in high school. We did end up winning though, and I threw a touchdown pass with a torn up knee. 1978. I just got to pull two muscles just saying 1978. Did get over it in time to play the second half of the hockey season that year, though, and baseball that year. My doctor actually put it into my medical file that not only did I throw a touchdown pass with the torn knee ligaments, but that I was made it back that quick. All right, that's enough killing time for that. Yeah, Richard, I didn't give out a lot of traffic tickets back then when I was a cop, though. To, we were usually busy with some other. I wasn't a big traffic ticket guy. All right, folks. If I start getting off on stories here, we'll be here till about 10 o'clock. So I'm going to go ahead and wrap it up. We put in the phone number you have, the VectorVest, the email address. You can call product support if there's anything we can do to help you out. Get you signed up for the course. We'd love to have you. Remember, it's money back guarantee, so you have nothing to lose. On behalf of John and myself, thank you for taking the time. Please stay safe, stay healthy, and we look forward to seeing you next time. Have a great evening. Thanks, everyone.